Stocks rallied after stronger than expected GDP data, but recession fears are still looming. Layoffs are spreading beyond the tech sector, but wages keep going up. What it says about the economy. And a few weeks after we turned bullish on Tesla, the company posts record earnings and the stock surges. On the Barron's Roundtable, my colleagues Ben Levisohn, Carleton English, and Jack Hough. So, Ben, another great week in the market.
Great week, great year.
Great month.
I mean, it's been fantastic. The NASDAQ has had its best January start to the year since 2001.
Wow.
And really, it only has to do with one thing, and that's inflation is coming down. We saw that again this week. We got new inflation data. It's lower than it was the previous month, and the market is just getting excited about the possibility of a soft landing. And they're sending all these stocks that they hated last year are going straight up.
So January 2001 is not the best time to be investing in the NASDAQ now that we have a crystal ball. You're still kind of skeptical of this rally. Is all this trader optimism just not justified?
I mean, I see a lot of similarities to 2001. We had, the kind of froth almost that we did back then, and right now people are excited. There are good reasons for that. Everyone had sold pretty much everything by the end of last year, so you have to start buying stocks again. They're getting excited by it. They're buying these stocks that they had already sold, but now we're going to have to see what happens, and I think you have to keep an eye on the recession indicators. It doesn't mean that we can't get a great rally between now and, say, mid-year, but I think we do get a recession sometimes towards the end of the year, and that's going to cause problems for the stock market.
Problems for the stock market, but it actually would be a pretty good setup for the bond market unless it's all priced in. What do you think?
I think it would be a great setup for the bond market. If we're talking about right now, the bond market has had a heck of a rally as well, and I don't think you want to jump right into those bonds and just start scooping them up. But this will be a better environment for bonds. But we're going to get a lot of data again next week. We're going to get the Fed. Another rate hike is coming, a quarter point. We're going to see payrolls are going to come, and we're also going to get the employment cost index, which is show what wages are doing, and all these things are going to have an impact on the market short term.
So the wage question is really interesting, Carleton. On the one hand, we're seeing all these layoffs about these big companies that we've all heard of, and yet what's Walmart doing? Raising the minimum wage from $12 to $14. So clearly they're not finding enough people. They got to hike wages. What's going on?
Yeah, so there's this huge disconnect in the labor market right now. To your point, we saw companies like Amazon, Alphabet, Microsoft, Salesforce announce these massive layoffs, not yet showing up in the broader economic data yet, because even though we use these tools every single day, they tend to represent about 2% of the total labor force. So the thing with those jobs is no one wants to minimize, the impact of job losses, but these types of workers tend to get absorbed quickly. They get rehired. It might not be Amazon to Google. It could be Amazon to a Bank of America that's looking to build out more of its AI products. But to your point, on the other side of the economy, where we do see Chipotle planning to hire 15,000 workers, about a third of that is to satiate Ben's burrito cravings. On the service side of the economy, anyone who's been to a restaurant realizes the challenges in the service sector now. Restaurants are now, in-room dining. They're also takeout places, and sometimes they're operating an outdoor restaurant too. So on the service side of the economy, not enough people.
Okay, so you weigh these two things together. What does it say about the broader economy?
Right now, I don't think that there is a reason to get worried. We are still looking at a very strong unemployment level at about 3.5%. Even people who expect there to be a recession, they see unemployment topping at about 5%. And that's really only a small bit above the natural rate of unemployment. So again, you don't want to minimize these things when people are going through difficult times. But for the broader economy, the impact does not seem to be too serious.
All right, so once in a while, Jack, the market actually turns away from inflation and markets and wages to think about something called earnings. Tesla, fantastic earnings. Meanwhile, Intel managed to go below even low expectations.
Yeah, Tesla. Now, our pal Al Rootin' Tootin' Root, as you say, was here just at the beginning of this year, and he recommended the stock. I was sitting right next to him, by the way. Don't feel like you have to give me any credit just for proximity. The stock is up about 50% since then. The whole market has gone full Cathy Woods, but especially Tesla. Earnings were okay, but they were record earnings. They didn't quite meet Wall Street's expectations. But Elon Musk says he's seeing the strongest orders ever to start this year. The company had cut prices on vehicles, some of them as much as 20%. At the beginning of the year, and he says that's a big part of spurring demand. And although margins will take a hit, it's not that bad because they were pretty good margins to start with. So investors were really cheered with this. They came out with guidance for vehicle deliveries. It's 30 7% growth this year. That's not quite what the company's growth algorithm was, but it's better than what investors thought. And the stock went bananas Thursday and Friday, basically. So then you've got Intel, totally different story. That company lost money during the quarter. Revenue declined more than 30%. The chip industry has gone from shortages to a glut. And Intel is losing share to AMD and the companies making their own chips using those ARM-based designs. I find it's not great when a company says, hey, our industry isn't doing so well right now, and people don't seem to want our products in particular. That's usually not good news for investors. The company did not give full-year guidance. The stock dropped 6%. It's down now 50% over 3 years.
New plant coming in Ohio. Maybe they can make great things there. But before I let you go, let's look ahead to next week. A lot of big companies reporting earnings.
Yeah, watch for Apple. The street expects an earnings decline on iPhone delays. Look for management comments on demand going forward. And we'll also hear from Amazon and Alphabet. We want to find out about companies cutting spending on advertising and or the cloud.
Yeah, we are.
All those stocks, by the way, are up big so far this year, so there's kind of high expectations there.
But it does look like we're entering an advertising recession. We'll see.